Have you ever lost money in the markets even when you did everything right? You followed your plan, trusted your setup, and still watched your account shrink. It's a gut punch that leaves you doubting everything. Then, maybe you hit a hot streak, 3, 4, 5 wins in a row. You feel unstoppable. But just as quickly, one bad trade wipes out all those gains, and you're back to square one, or worse. This emotional roller coaster is the reality for most traders, not the exception. The truth? A winning strategy is only a small part of the puzzle. The real challenge is surviving the chaos long enough for your edge to play out. Gurus sell dreams of high win rates and easy money, but they never mention the psychological traps and brutal randomness that define trading. In this video, we'll expose why even smart traders lose, the math behind inevitable losing streaks, and how to manage risk like a pro. Most importantly, we'll reveal the one critical element that separates the traders who thrive from the 90% who fail. Ready to see the market's unspoken paradox? Let's dive in. Let's shatter the biggest myth in trading, that a high win rate equals success. Even top institutional traders are thrilled with a 55 to 60% win rate. Why? Because the math is ruthless. With a 50% win rate, you'll hit 2 losses in a row every 4 trades. 3 losses, expected every 8 trades. These streaks aren't rare, they're guaranteed by probability. Even with a 60% win rate, you'll still face clusters of losses. 4 in a row? It'll happen. The system isn't broken. The math is just doing its job. The real question, can your account and your mindset survive these inevitable losing streaks? Most traders unravel here, abandoning good systems right before their edge plays out. Surviving the math is the real test, not just picking winners. If you can't handle the numbers, you won't last. Let's see why the obsession with being right is so dangerous. We're taught that being right means success. In trading, this belief is deadly. New traders chase systems with sky-high win rates, desperate for certainty and validation. But the best traders know it's not about being right on every trade. It's about being profitable over time. A high win rate feels good, but it's often fragile. One big loss can erase months of small wins. Pros accept being wrong as part of the game. They focus on long-term expectancy, not short-term ego boosts. Even a 40 to 50% win rate can be wildly profitable if your winners outpace your losers. The real shift? Stop asking, am I right on this trade? Start asking, is my system profitable over 100 trades? This mindset separates amateurs from professionals. Let go of the need to be right. Embrace the need to be profitable. Now let's see how randomness can look like failure, and why most traders quit too soon. A 50% win rate isn't a coin flip game, it's a test of your emotional endurance. 2 losses in a row, expect it every 4 trades. 3 in a row, every 8 trades. It's not bad luck, it's math. But to a trader obsessed with being right, these streaks feel like personal failure. You follow your rules, take your setups, and still lose. Doubt creeps in. Confidence crumbles. Most traders mistake this normal randomness for a broken system and quit right before their edge kicks in. The real danger isn't the losses, it's the unrealistic expectation of smooth, consistent wins. 4 or 5 losses in a row will happen, even with a solid system. These aren't black swan events, they're standard features of trading. If you don't understand this, you'll abandon good strategies at the worst possible moment. Surviving means accepting randomness, not fighting it. Next, let's talk about how to weather these storms and come out stronger. Even with a 60% win rate, losing streaks are inevitable. 2 losses in a row, every 6 trades. 3, every 16. The ride isn't smooth, it's messy, and the drawdowns are real. The emotional pressure during these streaks is intense. Most traders panic, tweak their systems, or quit. But the system isn't failing, the trader's expectations are. Surviving in this business isn't about finding the perfect system. It's about building the resilience to weather the storms. Accept that losing streaks are a normal cost of trading. Anticipate them, plan for them, and stick to your strategy, even when your P&L is bleeding red. The trader who gets this isn't a victim of randomness. They're a manager of probabilities. They ride out the storms, knowing the math will eventually swing back in their favor. This is the real edge: emotional resilience and unwavering discipline. Most will quit. But if you can survive the storm, you'll be among the few who thrive. The paradox isn't in the market, it's in how you handle the chaos. Now, the painful experience of a losing streak. That's what most traders dread. This string of losses, This cluster of negative outcomes is usually blamed for breaking a trader's spirit and honestly their account. We've already established that these clusters are just a mathematical certainty, a storm every trader has to learn to survive. But here's the twist, and it's something that catches almost everyone off guard. It's not actually the bad trades that pose the biggest threat to your long-term survival in the markets. The real sneaky danger, the trap that wipes out more accounts than any losing streak, is actually the cluster of good trades. Yeah, the winning streak is the wolf in sheep's clothing. It sounds totally counterintuitive, right? How could winning ever be more dangerous than losing? Well, the answer isn't in the math of your system, it's in the chemistry of your brain. When you're hit with a string of losses, your main emotions are fear and doubt. Those hurt, sure, but they usually lead to more cautious behavior. You might cut back your position size, double-check your analysis, or just take a breather from the screen. These are defensive, self-preserving moves. A losing streak hurts your P&L, but it puts your mind on high alert, forcing you to focus on risk and survival. It's a tough but important lesson in humility, a constant reminder of just how powerful the market really is. A winning streak, though, does the exact opposite. When you string together 3, 4, or 5 wins in a row, a totally different, much stronger set of emotions takes over. You feel this rush of euphoria, a huge boost of confidence and validation. The market starts to feel like it's bending to your will. Every decision feels spot on. Every analysis seems, well, almost prophetic. And you know, this isn't just a feeling, it's a real biological event. Your brain starts pumping out a powerful neurotransmitter called dopamine. This is the same chemical tied to reward, pleasure, and even addiction. It's your brain's way of saying, whatever you just did, do it again. That chemical surge feels amazing. It's an addictive high, making you feel smart, powerful, and most dangerously, invincible. You start to believe you've finally cracked the market's code, that you've reached this new level of trading mastery, where the old rules of risk don't apply to you anymore. And that, right there, is the beginning of the cluster trap. The positive reinforcement from all those wins creates a psychological state that's actually way more dangerous than the fear from losses. While fear makes you careful, this euphoria makes you reckless. You're not trading your system anymore. You're trading your ego, and your ego is getting fed by a powerful chemical cocktail. So, let's dig a little deeper into the biology behind why winning can be so dangerous. Every time you close out a profitable trade, your brain's reward system kicks in. Specifically, your pituitary gland gets the signal to release dopamine, which then floods into your bloodstream and spreads throughout your body. This is nature's way of reinforcing behaviors that help you survive, like finding food or hitting a goal. But in trading, your brain treats those green numbers on your screen as a huge win. After a string of victories, this process really ramps up. You're literally getting high on your own success, in a way that's pretty similar to a gambler on a hot streak. This dopamine-fueled euphoria actually changes how you see risk. The rational, analytical part of your brain, the prefrontal cortex, starts to take a back seat. Instead, the more primal emotional centers take over. The memory of your past losses fades into the background. All those lessons you learned about caution and discipline, they start to feel like distant, almost irrelevant advice from a less experienced version of yourself. You begin to believe that your winning streak isn't just a random cluster, but a direct result of your superior skill. You start to feel like you just can't lose. And this is what we call the invincibility fallacy, a cognitive bias that tricks you into thinking you're somehow immune to the risks that everyone else faces. This sense of invincibility is what opens the door to some truly catastrophic mistakes. It's that little voice in your head saying, "This setup is perfect, you should double your size." Or, it's the impulse to ignore your stop loss because the trade is going to turn around. You forget the golden rule of risk management because in that moment, risk feels like something for other traders to worry about. Now you're operating on pure emotion, driven by the intoxicating belief that you have some special insight into where the market's headed. You've stopped being a systematic trader managing probabilities, and you've turned into a gambler chasing the next big win. And this is where the real damage happens. Convinced you found your Midas touch, you go for it. You click that button to increase your lot size, maybe even doubling or tripling your usual risk. You throw out the very rules that got you those wins in the first place, thinking you've outgrown them. But the market, it doesn't care about your dopamine levels or your feelings of invincibility. It keeps running on the same cold, indifferent laws of probability as always. The next trade has exactly the same chance of being a loser as any other, no matter how confident you feel. Without realizing it, you've set a devastating trap for yourself, and the bait is your own success. The climax of the cluster trap is both predictable and tragic. Riding the high of your winning streak and your inflated sense of skill, you enter a new trade with a dangerously large position size. You have thrown your disciplined risk management plan out the window. For a moment, everything feels perfect. The trade might even move slightly in your favor, reinforcing your belief that you made the right call. The dopamine continues to flow, and your confidence soars to its peak. You are on top of the world, convinced that you are about to secure your biggest win yet, a victory that will cement your status as a master of the market. This is the precipice. Then, the market turns. It moves against you, slowly at first, and then with sudden, sharp momentum. The initial reaction is not fear, but disbelief. This can't be happening, you think. It's just a small pullback. It will come back. This is your ego fighting to protect the narrative of invincibility. You hold on, refusing to accept the loss, even as it grows larger and larger. The stop-loss level you would have normally honored is now just a meaningless line on the chart. You might even add to your losing position, an act known as doubling down, in a desperate attempt to prove yourself right and force the market to bend to your will. But the market is a relentless and impartial force. It does not respond to hope or ego. The loss continues to mount, growing far beyond anything you would have ever allowed under your normal, disciplined rules. In a matter of minutes, the single oversized position has wiped out all the profits from your entire winning streak. Then it goes further, cutting deep into your original trading capital. The euphoria evaporates instantly, replaced by a sickening cocktail of panic, regret, and shock. The fall from the peak of invincibility to the pit of despair is brutally swift, leaving you emotionally and financially devastated. This single, catastrophic loss, born from the arrogance of a winning streak, is what truly destroys a trader. It's not the small, paper-cut losses from a normal losing cluster. It's the self-inflicted mortal wound that comes from abandoning discipline at the height of success. This is why euphoria is infinitely more dangerous than fear. Fear makes you defensive and preserves your capital. Euphoria makes you reckless and exposes you to ruin. The hard truth is that your biggest enemy in the market is not a bad system or a string of losses. So if both winning and losing streaks create dangerous psychological traps, how do the real professionals, the traders who build lasting careers, manage to navigate these brutal, unpredictable waves? How do they survive the statistical storms of loss clusters and the siren song of euphoric win clusters? The answer is surprisingly simple, yet profoundly difficult to execute with consistency. It comes down to one single foundational concept that underpins all successful trading endeavors: the masterful management of risk. It's a word that gets thrown around a lot, but few truly grasp its power. It is the bedrock upon which all market fortunes are built, and the firewall that prevents catastrophic failure. Legendary traders stay alive in this difficult business not because they possess a crystal ball or a secret formula that allows them to predict the market's every move. They don't survive because they are always right. In fact, as we've discussed, they are often wrong nearly half the time. Their longevity, their secret to surviving and thriving through decades of market chaos, is rooted in a simple but powerful asymmetry. When they are wrong, when a trade moves against them, they lose a small, predetermined, and ultimately insignificant amount of capital. But when they are right, they don't just take a small profit. They let their winners run, aiming to make 2 times, 3 times, or even more than what they risked on the trade. This principle is what separates the amateur from the professional. The amateur trader is obsessed with being right. They will often take quick profits out of fear that the market will reverse, securing a small win that provides a satisfying dopamine hit. Conversely, they will let their losing trades run, hoping they will turn around, because taking a loss is an admission of being wrong. This leads to a disastrous equation: small wins and large losses. The professional trader inverts this entirely. They are perfectly comfortable with being wrong frequently, taking many small, controlled losses. They accept these as a necessary business expense. Their entire focus is on capturing those few large wins that will pay for all the small losses and generate significant profit. This approach fundamentally changes the entire trading game. It shifts the objective from the emotional need to be right on any single trade to the mathematical necessity of being profitable over a large series of trades. Risk is no longer a scary monster to be avoided at all costs. It becomes a tool, a calculated variable that can be precisely managed and deployed. By strictly controlling the downside on every single trade, the professional trader ensures that no single event can ever knock them out of the game. They live to trade another day, patiently waiting for the opportunities where the potential reward heavily outweighs their limited risk. This is the core secret of survival. This professional approach of cutting losses short and letting winners run is not just a vague philosophy. It is a concrete mathematical principle known as positive expectancy. Expectancy is the formula that determines if your trading system is profitable over the long run. It is the true measure of a strategy's viability, and it has nothing to do with your win rate alone. It is a combination of how often you win and lose, and the average size of your wins and losses. Understanding this concept is the moment a trader moves from gambling to running a professional trading business. It is the engine that drives all sustainable profitability in the markets. Let's illustrate this with a clear numerical example. Imagine you have a trading system with a 50% win rate, the statistical equivalent of a coin flip. If your average win is the same size as your average loss, you will simply break even over time, churning your account. But what happens if we introduce the professional's risk asymmetry? Let's say you decide to risk a fixed $100 on every single trade. This is your maximum acceptable loss. However, when a trade goes in your favor, your plan is to take profit only when it reaches $300. You are aiming for a reward that is 3 times your initial risk. Now let's look at the math over a series of just 10 trades. With a 50% win rate, you can expect to have 5 winning trades and 5 losing trades. Your 5 losses, where you strictly adhered to your stop loss, will cost you a total of $500. 5 trades times negative $100. However, your 5 winning trades, where you let your profits run to your target, will generate a total of $1,500. 5 trades times positive $300. When you subtract your total losses from your total gains, you are left with a net profit of $1,000. This is the magic of positive expectancy. You were only right half the time, yet you made a significant profit. This is how you win with a system that feels average. You don't need to be a market wizard who is right 80 or 90% of the time. You simply need a system where your wins are meaningfully larger than your losses. This mathematical edge is what keeps you in the game. It provides the financial and psychological buffer needed to endure the inevitable losing streaks. When you are in a drawdown, losing 3 or 4 trades in a row, you can remain calm and disciplined because you know with mathematical certainty that just 1 or 2 winning trades will be enough to erase those losses and put you back into profitability. Having a system with positive expectancy is one thing. Having the iron-willed discipline to execute it flawlessly is another entirely. This is where, honestly, the true challenge of trading lies. The mathematical formula for success is simple to write down, but it is incredibly difficult to follow when you are in the heat of the moment, with real money on the line and powerful emotions coursing through your veins. The plan only works if you stick to the plan. This holds true during the best of times and, more importantly, through the absolute worst of times. The professional trader is not just an analyst, they are a master of execution under pressure. Consider the pain of a losing streak. After 4 consecutive losses, even when you know they are statistically normal, the emotional pressure to deviate from the plan is immense. Your confidence is shaken. The 5th setup appears, looking identical to the 4 that just failed. Your mind screams at you to skip this one, to wait for more confirmation, or to cut your risk in half. The professional, however, ignores this internal noise. They know that their edge only manifests over a large sample of trades. Skipping a trade breaks the statistical integrity of the system. They take the 5th trade with the same risk parameters and the same conviction as the 1st, treating it as just one event in 1,000. Now consider the opposite scenario, the euphoric high of a winning streak. After 4 consecutive wins, you feel invincible. The next setup appears, and your dopamine-fueled brain tells you to be aggressive. You can't lose, it whispers. Double your position size. This is the one that will make your month. An amateur gives in to this temptation, abandoning their risk rules and placing a massively oversized bet. The professional resists. They recognize euphoria as the danger signal it is. They stick to their predetermined risk of $100, knowing that this single trade's outcome is random, and that protecting their capital is more important than chasing a bigger high. This unwavering discipline is the final, crucial piece of the risk management secret. It is the bridge between a theoretical edge and real-world profits. It requires you to act like a robot, mechanically executing your predefined rules regardless of your fear, greed, or ego. You must honor your stop-loss without hesitation. You must let your profitable trades reach their targets without snatching them away prematurely. You must maintain a consistent position size through both winning and losing streaks. This relentless consistency is what allows the law of large numbers and the power of positive expectancy to work in your favor. It is the defining characteristic of a true trading professional. Let me tell you a story, a real-world example that perfectly illustrates the power of detaching your emotions from your trading execution. This isn't a hypothetical scenario. It's a true account from a seasoned trader that powerfully demonstrates how our own interference is often the biggest obstacle to success. Years ago, this trader, let's call him James, had been meticulously analyzing the commodities market. He identified what he believed was a prime long-term opportunity in copper. The charts showed a strong bottoming pattern, and fundamental analysis suggested a looming supply deficit. After days of careful planning, he placed a long position, setting his profit targets and a well-calculated stop-loss order to protect his capital. Shortly after placing the trade, James had to leave for a long-planned trip from his home in South Africa to London. In the rush of preparing for his international flight, he quickly checked his trading platform. He saw a flicker of red, and in a moment of haste, mistakenly believed his stop-loss had been triggered, kicking him out of the copper position for a small, manageable loss. Shrugging it off as just another cost of doing business, he closed his laptop, put the trade out of his mind, and headed to the airport. He was completely convinced that the trade was over and done with, a minor event in his trading week that required no further thought or attention from him. This misinterpretation was the critical, unintentional ingredient for what was about to happen. Had he known the trade was still active, he would have likely spent his entire flight anxiously checking for patchy in-flight Wi-Fi, scrutinizing every small price fluctuation on his phone. He would have been tempted to move his stop-loss, to take a small profit prematurely, or to second-guess his entire analysis at the first sign of a minor pullback. His emotions, his fear of losing, and his anxiety about being wrong would have been tethered to every tick of the copper price. The trade would have consumed his mental energy, turning his vacation into a stressful ordeal of constant screen watching and emotional turmoil. Instead, liberated by the false belief that his position was closed, he was completely detached. There was no emotional interference, no urge to micromanage, and no temptation to deviate from his original well-researched plan. He boarded the plane with a clear mind, looking forward to his time in London, completely unaware that his capital was still at work in the market, silently following the path he had initially laid out for it. The system was in place, the parameters were set, and for once, the trader himself was not there to get in its way. This accidental detachment set the stage for a powerful lesson in the psychology of trading. Arriving in London, James fully immersed himself in his vacation, the supposedly closed copper trade a distant memory. The highlight of his trip was an evening he had been looking forward to for months, seeing the legendary Celine Dion perform live at the iconic Royal Albert Hall. The atmosphere inside the historic venue was electric, filled with anticipation. As the lights dimmed and the orchestra began to play, the entire audience was captivated. The theme of the night was the music of the film Titanic, and the powerful ballads filled the grand hall, creating a truly unforgettable and emotional experience for everyone present. Throughout the entire concert, James was completely present. He wasn't secretly glancing at a trading app on his phone under the dim lights. He wasn't mentally calculating his profit or loss. His mind was not on candlestick charts or market indicators. It was absorbed by the soaring vocals and the magnificent performance unfolding before him. He experienced the event with his full attention, sharing in the collective emotion of the crowd. This period of being completely unplugged from the market was not just a vacation for his body, it was a crucial vacation for his trading mind. freeing him from the cycle of anxiety and emotional decision-making that plagues so many active traders. As the final powerful notes of "My Heart Will Go On" echoed through the Royal Albert Hall, and the audience rose for a standing ovation, James felt a sense of pure contentment. The night was a perfect escape. It was only later, back at his hotel, that he decided to log into his trading account, not to check on the copper trade, which he still believed was long gone, but to get a general overview of the markets and plan for the week ahead. He casually opened his platform, expecting to see his normal account balance, minus the small loss he had already accepted from the copper position several days prior. What he saw on the screen made his jaw drop. Boom! A flash of bright green and a number so large it took him a moment to process. His account balance had surged by thousands of dollars. Confused, he scanned his open positions, and there it was, the copper trade. It had never been stopped out. In his absence, while he was flying across continents and being moved by the power of music, the trade had not only survived, but had thrived spectacularly. The market had moved exactly as his initial analysis had predicted, hitting his aggressive profit targets in a powerful, uninterrupted trend. In that moment of stunned silence, just staring at the screen, James learned one of the most profound lessons of his entire trading career. The single best trade he had made in months was actually the one he didn't manage at all. It succeeded, not because of his constant vigilance, but because of his complete and utter absence. The trade had been allowed to breathe. It followed the natural course of the trend he had correctly identified, totally unhindered by the emotional impulses that would have inevitably surfaced if he had been watching its every move. He had created a solid plan, and honestly, his accidental negligence was the one thing that forced him to follow it perfectly. This copper miracle was a textbook demonstration of a core trading truth. Often we are our own worst enemies. Our desire for control, fueled by fear and greed, leads us to constantly meddle. We see a small profit and snatch it off the table, afraid it will vanish, and in doing so, we cut our winners short. We see a small loss and rationalize moving our stop loss just a little bit further, allowing a small, manageable loss to metastasize into a devastating one. This constant tinkering, this emotional micromanagement, disrupts the statistical edge of a positive expectancy system, preventing it from ever working its long-term magic. The success of the copper trade was entirely due to the fact that the system was allowed to operate without emotional friction. The initial analysis was sound. The risk was clearly defined by the stop loss. The potential profit was outlined by the take-profit targets. Once the trade was placed, the trader's job was technically done. The market was going to do what it was going to do, regardless of how intently he watched it. By being away, he was unable to second-guess his well-laid plan. He couldn't panic during a minor dip or get overly excited during a surge. He simply let the system he designed do its job. The ultimate lesson from this story is not that you should place a trade and immediately go on vacation, just hoping for the best. The lesson is about trust and detachment. It's about trusting your analysis and your system enough to let it play out without constant interference. It's about understanding that once a trade is live, your psychological biases are, honestly, more likely to harm it than to help it. The best trades are often the ones where you have the discipline to set your parameters and then step back, letting your predefined plan, and not your in-the-moment emotions, dictate the outcome. True emotional control is sometimes achieved by simply walking away. So, we have established the mathematical realities of trading. We know that even a profitable system will produce painful losing streaks. We've seen how winning streaks can be even more dangerous, creating a sense of euphoria that leads to reckless mistakes. We understand that the secret of the pros lies in disciplined risk management and a system with positive expectancy. This brings us to the most critical question of all. If the roadmap to success is relatively clear, why do the vast majority of traders ultimately fail? Where precisely do most of them go so disastrously wrong on their journey? The answer is as simple as it is tragic. Most traders quit. They give up just before their edge has a chance to manifest. They abandon their strategies not because the systems themselves are flawed, but because they cannot emotionally withstand the natural, random behavior of the market. After a few unexpected losses, they break their own meticulously crafted rules. They might engage in what is known as revenge trading, where they jump back into the market after a loss, without a valid setup, driven by a desperate need to make their money back immediately. This is not trading. It is emotional gambling, and it almost always leads to even greater losses, accelerating the downward spiral of their account and their morale. This is the point of failure. It is the moment when the trader's emotional discipline cracks under pressure. You can have a system with a 65% win rate and a 3-to-1 reward-to-risk ratio, a virtual license to print money on paper, and still fail. You can backtest a strategy for years, prove its profitability with mountains of data, and still blow up your account. The system itself is not the weak link in the chain. The numbers are sound, the logic is valid, the edge is real. The system didn't fail, the trader did. They failed to execute the system with the robotic, emotionless consistency that it requires. The wreckage of a failed trading account is often accompanied by a note of bitter irony. The trader who quits after 5 straight losses often does so right before the system is about to deliver 6 straight wins. They abandon their plan at the point of maximum pain, just before the pendulum of probability was due to swing back in their favor. They blame the market, they blame their broker, they blame the gurus who sold them the system. But the truth is, the failure was internal. It was a failure to accept the fundamental nature of randomness, and a failure to maintain discipline when it mattered the most. Why is this execution failure so common? Why is it so profoundly difficult for intelligent, motivated individuals to simply follow their own rules? It's because, honestly, human beings are not built to thrive in an environment of pure randomness. Our brains are pattern recognition machines, evolved over millennia to find cause and effect in the world around us. This skill was essential for survival. If you ate a red berry and got sick, you learned to associate the red berry with sickness. This cause and effect thinking is hardwired into our very being, a fundamental part of how we make sense of our environment and protect ourselves from harm. Trading, however, operates in a different reality. In the short term, the market is a realm of profound randomness. The outcome of any single trade is essentially a coin flip, regardless of how perfect the setup appears. When a trader experiences a cluster of losses, their brain instinctively tries to find a cause. It concludes, I followed my rules, and I lost money. Therefore, my rules must be wrong. This feels like a logical conclusion, but it is a fatal misinterpretation of probability. The trader is applying cause and effect logic to a series of random events, and this cognitive dissonance creates immense psychological stress. They can't accept that they can do everything right and still lose multiple times in a row. This psychological weight becomes unbearable over time. The trader who doesn't truly, deeply understand and accept the role of randomness will inevitably break. They don't expect the clusters of losses, so when they arrive, they are treated as a catastrophic failure of the system, rather than a normal, predictable occurrence. They see a pattern of failure where there is only a temporary statistical clump. This perceived failure erodes their confidence in their strategy. Once that confidence is gone, the discipline to follow the rules vanishes along with it. Why would you rigidly follow a plan that you no longer believe in? This is the final hurdle that separates the few who succeed from the many who quit. It is the ability to operate with unwavering discipline in the face of outcomes that feel illogical and unfair. It requires a form of mental toughness that is rare, a conscious decision to override your brain's natural instincts. You must stop searching for meaning in random noise. You must let go of the need for the market to make sense on a trade-by-trade basis. You must have absolute faith in the long-term math of your system, even when the short-term results are painful. The traders who quit are the ones who could never carry this psychological weight. We have journeyed through the hidden truths of trading, dismantling the myths and confronting the uncomfortable realities that most aspiring traders never see. We've seen that a high win rate is an illusion, and that even the best systems produce painful, confidence-shattering losing streaks. We've uncovered the counterintuitive danger of winning streaks where dopamine-fueled euphoria can lead to reckless, account-destroying decisions. The ultimate success of a trader is not a simple function of a good strategy. It is a complex interplay of mathematics, psychology, and above all, unyielding discipline. The final truth is this: trading success is not about being right all the time. The real game is not about predicting the market's next move with perfect accuracy. That is a fool's errand, a chase for certainty that simply does not exist. The real game is about survival. It is about staying in your chair, with capital in your account long enough for the statistical edge of your system to play out. It is about having the financial and emotional resilience to weather the inevitable storms. Your primary job as a trader is not to generate profits on any given day. Your primary job is to manage risks so effectively that you can guarantee your participation tomorrow. This requires a profound mental shift away from the outcome of any single trade. You must learn to decouple your sense of self-worth from your P&L statement. A losing trade does not make you a bad trader, just as a winning trade does not make you a genius. They are simply data points, two sides of the same probabilistic coin. The professional trader views both wins and losses with the same emotional detachment. They are simply feedback from the market, confirming that they are executing their plan and allowing the laws of large numbers to do their work. This is the path to freeing yourself from the emotional roller coaster of hope and fear. So when you face that inevitable string of 3, 4, or 5 losses in a row, remember this. Do not panic. Do not question your system if your research was sound. Do not deviate from your plan in a desperate attempt to stop the pain. Recognize the cluster for what it is, a normal, predictable, and temporary feature. It is a test of your discipline, not a verdict on your ability. Your task is to remain calm, to continue executing your plan with robotic consistency, and to trust in the positive expectancy you have built into your system. Conversely, when the market blesses you with a string of exhilarating wins, you must be even more vigilant. When you feel that intoxicating rush of euphoria, that feeling of invincibility, recognize it as the clear and present danger it is. This is the moment your discipline is most at risk. Do not get cocky. Do not foolishly believe you have suddenly cracked the market's code and that the rules no longer apply to you. This is the siren song that has led countless traders onto the rocks of ruin. This is the moment to double down, not on your position size, but on your commitment to your risk management rules. Your path forward, your personal journey toward trading longevity, is paved with these principles. Plan every single trade with meticulous care before you enter the market. Define your entry, your stop loss, and your profit target. Then, once the plan is made, your only job is to trade that plan without deviation. Respect the awesome power of risk on every single trade, knowing it is the one variable you can truly control. And you must learn to respect the profound influence of randomness, accepting that you cannot control short-term outcomes, no matter how much you may want to. Survive the clusters, both winning and losing, and you will thrive. The journey to becoming a consistently profitable trader is not a sprint, it is a marathon. It is a business built brick by brick, through consistency, patience, and an unwavering commitment to a process. It is about staying calm when others are panicking. It is about staying humble when others are euphoric. It is about letting your system, your mathematical edge, do its job without your emotional interference. This is the hidden truth that separates the 90% who fail from the few who build lasting success and freedom through the markets. The power to succeed is not in finding a holy grail, but in mastering yourself. So as you move forward from here, take this knowledge with you. Let it be the foundation upon which you build your trading career. Let it be the voice of reason that guides you through the inevitable chaos of the market. Stay calm, stay disciplined, and stay in the game. Allow your well-designed system to work for you over the long run, and you will find that the consistency you seek is not in the market's behavior, but in your own. The path is not easy, but it is clear. The rest is up to you.